All right, welcome to The Explainer. So, you just landed your first real job. That's awesome. And that feeling when you see that first proper salary hit your bank account? Man, it's incredible. But what if I told you there's a hidden force, a kind of ghost that's already nibbling away at that hard-earned cash? Well, today, we're going to shine a big old light on that ghost so you can actually keep more of what you earn.
So let's start with a feeling I bet is super familiar to you. You're doing all the right things, right? You're trying to be responsible. Maybe you even set up your first real savings plan. But then you look at your account and you're just like, where did it all go? It's not like you went on some crazy spending spree. It just seems to vanish.
Okay, first off, that feeling doesn't mean you're bad with money. Not at all. It's actually got a name. It's this silent thing that works in the background of our whole economy, and we're calling it the ghost tax. And you know what? Today, we're going to expose it so you can finally start fighting back.
So how exactly does this ghost tax get you? Well, its first trick, and honestly its most dangerous one, is that it makes you feel totally safe while your money is literally disappearing right under your nose.
You know, we're all kind of wired the same way psychologically. We see a number in our bank account and we think, okay, that's its value. So if you have $20,000 saved, you think you have $20,000. Simple, right? But the real question, the one that really matters, isn't how many dollars you have. It's what can those dollars actually buy. In this chart, it lays the problem out perfectly. So look at that little bar on the left. That's the tiny bit of interest your savings account might be earning you, maybe 0.5% if you're lucky. Now look at that big bar on the right. That's inflation, the speed at which prices are going up at 4%. See that huge, massive gap between the two? Yep, that's the ghost tax, right there in action.
So what does that gap mean? It means your real return is actually negative. You're losing money. To put it in perspective, for every 20,000 bucks you have saved up for a big goal, you're losing about $700 in purchasing power every single year. You didn't spend it. It just poof, evaporated.
This is the whole point right here. The number in your bank account looks stable. It feels safe, but its actual value, what it can buy, is silently shrinking every single day. Think about it like this. Your cash is basically a big ice cube sitting in a warm room.
But wait, it's not just about the money sitting in your savings account. Oh no. The second ghost is way, way sneakier. This one targets your spending habits. And it's especially good at hitting you when you're just getting used to having that first real, regular income.
I mean, think about how this works. Prices go up for everyday stuff, right? You complain about it for a week or two, but then what happens? You just adjust. You start paying it. That $5 coffee becomes $5.50. Your rent goes up a bit, and pretty soon it's just your new normal. There's a fancy term for this, hedonic adaptation. But all it really means is that we get used to it, and that makes the true cost of inflation almost invisible.
Okay, let's really break this down. Let's compare what this new normal feels like versus what it's actually costing you. So on the left, it just feels like, an extra few $100 a month on stuff. No big deal. But look on the right. That's the real cost. That's thousands of dollars every year that you could have been investing for your future, but now you can't.
And this number right here, this is where it gets really painful. This shows you the long-term damage. That little extra $500 a month doesn't just cost you $6,000 a year. No. If you had invested that money over 20 years, it would have grown into over $250,000. That's a staggering amount of lost future wealth.
Look, especially for you, just starting your career, time is your single biggest financial superpower. And here's the thing. Inflation doesn't just steal your money. It steals your time. Every single dollar that inflation forces you to spend today on stuff that used to be cheaper is a dollar that can't be invested and put to work. It loses out on decades of potential growth from compounding. You know that amazing snowball effect where your money starts making its own money?
All right, on to our third ghost. And this one is how the system itself can end up taking a bigger slice of your paycheck. And it often happens right after you get that first exciting cost of living raise. We call this the triple squeeze, and here's how it works. First, you get a pay raise to keep up with inflation, and you feel richer. Awesome. But second, your actual purchasing power hasn't really gone up. And third, that raise might have just bumped you into a higher tax bracket. So what happens? You end up paying more in taxes for basically no real gain in your wealth. It's a squeeze from all sides.
This metaphor is just perfect for this. Think about it. Just earning a salary and sticking it in a savings account is like standing still on one of those moving sidewalks at the airport. You feel like you're holding your ground,
but the walkway is moving, so you're actually going backward, further and further from your financial goals.
Okay, so after all that, the really important question is, what in the world are you supposed to do about it? Because listen, this isn't just about doom and gloom. There is absolutely a clear, actionable plan you can use to protect yourself.
So here it is, your 3-step defense plan. It's simple. Step 1, separate your cash. You absolutely need an emergency fund. We're talking 3 to 6 months of expenses, liquid. But anything on top of that, it needs to be put to work. Step 2, you gotta invest, and do it intentionally. That means long-term investments that have a history of beating inflation. And step 3, audit your new normal. You have to consciously fight back against that lifestyle creep we talked about.
Let's just zoom in on that second step for a second, because this is really how you fight back. If you look at the stock market, historically, it's returned something like 8 to 10% a year on average. That is way, way higher than inflation over the long haul. The real secret? You have to stay invested for the long term and not panic and jump out every time the news gets a little scary.
All right, let's wrap this all up with the big takeaway. Building wealth, especially right now at the start of your career, isn't just about how much you earn. It's about what you manage to keep and, more importantly, what you make grow.
Because the real difference between struggling and building something real isn't just your income. It's awareness. And then it's action. Just understanding these hidden forces, these ghost taxes, is the most powerful first step you can possibly take. Think of your income as your tool. Awareness is the instruction manual that shows you how to build something that'll actually last.
Honestly, if you only remember one single thing from this entire explainer, please let it be this. Cash feels safe. I get it, it looks stable in your account, but when there's inflation, it is silently, constantly, and guaranteed to be melting away. So the final question I want to leave you with isn't how much can I save? The real question is, how can I put my savings into motion? Because protecting your future, it all starts right there. Making sure your money is moving forward and growing, not just sitting there, melting in place.